The four-factor dividend growth strategy is not off to a good start for fiscal year 3. 2 months in, the portfolio tracking this strategy is down 3.7%. Given that the stock market finished last year on a sour note with a lot of volatility, this is not at all surprising. The portfolio is trailing the two benchmarks I compare it to, schd and the S&P 500. schd has a return of minus 2.33%, placing it 1.38% ahead of the four-factor portfolio. And the S&P 500 is up 3.35%, placing it a whopping 7.05% ahead of the four-factor portfolio. Suffice it to say, the four-factor strategy has found itself in a slump. I can't say I was expecting this to happen, but I will say that I'm not surprised or concerned by this. Most strategies will have better and worse periods, so this unfavorable period for the four-factor strategy, statistically, was bound to come sooner or later. I'll get into this a bit more later on when I talk about the monthly four-factor tracking sheet. Right now, I would like to focus on why this short-term underperformance is not concerning for me. As an investor focused on long-term results, I don't let myself be fazed by short-term underperformance, much less to allow such events to drive my decisions. The best thing to do when you find yourself underperforming the stock market or your benchmark is to reevaluate your overall strategy. And the reason for the reevaluation is to make sure the strategy you are following still makes sense to you. That being said, the four-factor dividend growth strategy still makes conceptual sense to me. The strategy focuses on finding high-quality dividend growth stocks, and through its ranking process, it attempts to identify the most opportune ideas to hold for the upcoming year. In my opinion, this stock selection process is based on sound principles that should lead to strong long-term results, and therefore I am not deviating from the path I am on with this portfolio. When I set this portfolio in motion on November 1st, 2022, the goals were simple. I wanted to achieve a long-term compound annual growth rate of at least 12%, and long-term for me is defined by at least 5 years. The second objective was to create a growing dividend stream. That's it. Those are the only two goals I have for this strategy. So let's talk about the long-term results thus far and see if this portfolio is meeting its objectives. Since inception, through the end of December 2024, the portfolio has a CAGR of 17.69%, giving it a 5.69% cushion above the target 12% CAGR. The portfolio generated 32.24% more dividend income in fiscal year 2 relative to fiscal year 1, hitting very nicely on the dividend growth objective. Looking at the dividend growth rate from a projected annual dividend income approach, the portfolio has increased its PADI by 24.34% since inception, or at a rate of 10.58% per year. So again, we can see the strategy has clearly delivered on this objective in the past 26 months. We're just about at the halfway point of my 5-year test window, and while it's nice to see the portfolio has a solid start, it's pivotal that this strategy continues to deliver on both of these objectives in the months to come. 1 or 2 months of underperformance are a bit meaningless in the span of 5 years. I can tell you that as of January 13th, the portfolio is up 1.7% month to date, while the S&P 500 is down 0.73%, and schd is down 0.07%. So the portfolio has already begun making up some of the lost ground in the first 2 months of fiscal year 3. But we still have 9.5 months to go before the next rebalancing event, and a lot can still happen. A big component of this strategy is to patiently sit on the sidelines and allow this process to work, with no guarantee that it will. So again, the important thing to remember here is that conceptually, the process makes logical sense to me, and that is why I originally decided to allocate capital into this strategy. I've been tracking and sharing with my Patreon community a new four-factor list every month. My portfolio is on the November to October 12-month cycle, but I wanted to see how other 12-month cycles would have worked out as well. And I wanted to see how much rotation there would be on this list from month to month. Taking a look at the results of this data, we can see that the 8 four-factor lists that have completed a full 12-month cycle have on average returned 24.68%. This is about 5% better than schd, and about 4% below the S&P 500 on average. And the 12 four-factor lists that are ongoing are in a bit of a slump. However, there is some light at the end of this tunnel. The lists from April 2024 through December 2024 all have negative returns thus far, and for the most part, they are grossly underperforming the S&P 500 and schd. The freshly minted January 2025 list is off to a rather promising start, with an overall positive return, while schd and the S&P 500 are still sitting in the red. Just like the four-factor strategy went out of favor in early to mid-2024, perhaps it's set to make up for this deficit in 2025. It's still too early to tell, and since I don't have a crystal ball, I won't be making such bold predictions. But I have conviction that this strategy will deliver the results I have set out for it to attain. To remind you, those goals are a 12% long-term CAGR and a growing dividend income stream. While the pending four-factor lists have quite significant margins of underperformance relative to both benchmarks, that I don't expect most of them will be able to recover before they complete a full 12-month cycle, I want to judge the effectiveness of this strategy based on the lists that have already completed a full 12-month cycle. If we take a quick look at the average statistics for all of the past four-factor lists, we can see that on average, the chosen stocks are quite attractive. The 20 four-factor lists to date have on average offered a starting dividend yield of 2.25%. The first four-factor list for June of 2023 had the highest starting dividend yield of 3.15%, and the April 2024 list had the lowest yield of just 1.88%. The average 5-year dividend growth rate clocked in at a very high 21.49%. The highest 5-year dividend growth rate was offered by the May 2024 list at 24.38%, and the lowest coming from the November 2023 list at 18.96%. The average return on capital was a very respectable 24%, and we can observe that this metric is actually trending lower over time, as the highest return on capital came from the June 2023 list at 27.68%, with the lowest coming from the latest January 2025 list at 21.1%. In terms of liquidity, the free cash flow to total debt ratio has remained very healthy for all 20 lists, with the average being 529.65%. We did have one outlier in March of 2024, where the average ratio was just 227.94%. And while that may seem considerably lower, it's still a very healthy position to have more than double free cash flow relative to total debt. These financial metrics can give you a sense of the quality presented by this strategy, while the average yield can indicate the valuation and current market sentiment. The average turnover amongst the 20 chosen stocks each month has been very low, clocking in at 2.32 changes per month on average. For any of you that have followed this strategy since the beginning, you may recall that the portfolio was made up of 30 stocks in its first year. Then it was trimmed to just the top 25 stocks in year number 2, and further trimmed to just the top 20 stocks in the current third year. These changes from year to year were based on patterns from the data I collected. This year, I am tracking the inverse of what I tracked previously. I'm tracking how the top 25 stocks would have performed opposed to the actual top 20 that were included in the portfolio. The initial outcome is not favorable. The larger portfolio, made up of 25 stocks, would have seen a higher total return both in November and December, with the cumulative alpha standing at 47 basis points. The stocks that ranked 21st to 25th were NXP Semiconductor, Nike, Home Depot, Accenture, and MasterCard. And as of right now, the decision to further concentrate this portfolio around its top selections is not panning out as expected. But we are just 2 months in, so who knows if this unfavorable pattern won't reverse over the next 10 months. If you want to know more about the four-factor strategy, I have an entire playlist on YouTube dedicated to it. You can also follow me on Seeking Alpha, where I publish a monthly update, or you can join my Patreon, where I publish a new four-factor list at the end of every month, and give you access to the tracking sheet that includes the full history that I summarized today. I hope you enjoyed the content. Don't forget to like and subscribe. See you next time.